Michael Lewis with us. Let's bring him in right away. And we're going to bring up his book here, The Big Short, Inside the Doomsday Machine. Once again, a success. I want to talk about The Big Short later in our section with you. I want to go right to Vanity Fair. But is there a movie? I mean, everybody else has a movie.
The Big Short?
Is it going to be made? You know, give me the movie story.
So Brad Pitt is starring in Moneyball, which is another book I wrote. It comes out in September, and he bought the rights to The Big Short with Paramount.
Do you like an actor buying the rights? I think that's sort of cool.
Yeah, you know, and he's interesting because he doesn't actually insist on being in it. So it's written as if it might not be for him, and if it works for him, it works for him. I think actually, the problem with the story as a movie is the absence of physical action. But if you see The Social Network, totally works, and there's no physical action.
Yeah, total aside, everybody trashed on Zuckerberg about awkward at this thing, Saturday Night Live. I totally disagree. I don't think he was awkward. He was normal. That's, you know.
That's normal now.
That's normal now.
It wasn't normal when you were 20.
Or when you were a history major at Princeton. Vanity Fair, what a success. You personalize the data. Let's go to dreaded first chart here. Michael, you can see it down here on the monitor. Ireland failed at Moneyball. They did their own Moneyball. Billy Bean got it right. Ireland didn't. There's a spread, Irish to German spread. Okay, that's the math. Everybody that watches the show know that. You go to the soul of the story. What was the biggest surprise in When Irish Eyes Are Crying?
How much suffering the people are willing to put up with to shoulder what are essentially private debts. That the banks ran up these debts, and the government bailed out not only the senior but the subordinated bondholders to the tune of 80-something billion euros. It's just too much for the country to sustain. But that the people put up with it is amazing. I guess the other thing that was, you know, for me, this is part of a series. It's kind of financial disaster tourism.
Yeah.
I went to Iceland. I went to Greece, and in each case, sort of looking at a similar disease, something caused by a similar force, and it's cheap money rolling across the globe in the early part of the decade.
But can't we say manufactured cheap money? It was a conscious decision to make it cheap money.
Yes. So this credit rolls into places, into people that just would never have had it on these terms before, and you can see a lot about the culture by what they decided to do with the money. Each place is a little different, actually a lot different.
I'm a big believer in cultural economics. Okay, you've got three people in your cover picture here, one guy, one woman, and Morgan Kelly hanging out having a cup of coffee. They all got to be asking the same question: when are those responsible going to take a haircut? That's the jargon we use. Based on your reporting, who is going to take the haircut?
Well, this is interesting because up until last September, there were still a lot of outstanding bonds in these banks, but they've been mostly redeemed. The biggest chunks have rolled out. So what's happened is private debt, guaranteed by the Irish government, has been replaced by debt to the European Central Bank, and so. Now you've got an international crisis brewing, which is what happens when the Irish taxpayer stiffs the German taxpayer, which is what is going to happen, I think. And it won't be probably as bald a thing as it won't be called a default, but there's going to have to be some restructuring of the terms. And I think that's going to cause a lot of political friction.
My best read on crisis is David Kennedy's Pulitzer Prize volume on the American Depression and into World War II. He asked the same question you ask on the front of the Vanity Fair article: where's the rage? How can we have these crises, these elites screw it up, and the people be docile? Did you find the Irish people docile?
Yes, that's changing. And the answer is there's a real lag between the crisis and people feeling the crisis. I mean, that's true in this country, too. I mean, the hits to people's standards of living take a while to happen. And it's when they happen that the politics change.
And we see one thing here. Let's bring it up, folks. This is When Irish Eyes Are Crying, again, Vanity Fair. What a human story of what we talk about with spreads and math. No charts here. The Irish are once again leaving Ireland along with the hordes of migrant workers. I mean, it is a depeopling of Ireland to a great extent.
Yes, but it's different from past depeoplings of Ireland. I mean, Ireland is a history of depeopling, right? In this case, the first thing that happens when the crisis strikes is the migrant workers leave. I mean, there were by Polish estimates, 250,000 Poles in Ireland, which is an incredible number. I mean, in a society that's got 4 million plus people. And not long after the banks collapsed, the people who ran the short-term parking lot at the Dublin airport found that they weren't getting the normal revenues, but the lot was full, and Polish workers were driving to the airport, dropping the cars, and going back to Poland.
That's
and
amazing.
The Bank of Ireland sent people to try to collect from these Polish people back in Poland. They couldn't find them.
Right. Here's the book, folks. New Afterword. It's a new publishing gimmick. Write a new afterword. Michael Lewis does it. It's great. It's smart. Here's a quote I love. A book I had thought of mainly as a real-life story, so good that only its author, Michael Lewis, could screw it up, had somehow become a policy paper on the roots of the financial crisis. We're with Michael Lewis in celebration of his Irish article in Vanity Fair, and also the redo, the beach do, the paperback do of The Big Short. Brad Pitt taking on the movie rights and the responsibility to get it right. You're a successful author. You bring a book out. Everybody's stroking your ego saying, great, great, great. But this book became different. As we said going out, all of a sudden it became important. You just were writing a picture. You were painting a picture of what happened, and yet policymakers grabbed onto it. Why was that?
You know, what pulled me to the subject again was the quality of this narrative, the story, and the idea that people would treat it as useful never really occurred to me. And I was, I've been inundated with calls from people who have been trying to fix the financial system. And when they call me, my response is, if you're calling me, you're in trouble, kind of thing. But I think the answer to why they were calling me is that there was a vacuum. That I think that this Wall Street collapses. It's not only is it in many cases literally bankrupt, but from the eyes of the people who are trying to figure out what happened, it's without reliable sources. That you can't call the guy at Goldman Sachs or the guy at Moody's to come and explain what happened, because they're going to talk their own book. And so I think there was a grasping for people who were sort of outside who could explain the inside.
Yeah, I really felt that right during the heat of it. Rex, bring up the Michael Burry quote, if you would. Page 187, The Long Quiet. And they're going to get it up here. There we go. The source of his unhappiness was, as usual, other people. The other people who bothered him the most were his own investor. Who is Michael Burry? This to me was the most painful sentence in the book. How did this happen?
Well, he is a hedge fund investor with Asperger syndrome who doesn't know he has Asperger syndrome. He has absolutely no interest.
Is that like Rain Man?
Yeah, it's not as extreme as that, but it is a real discomfort with personal interaction, and so he had alienated his investors, I think, personally a little bit, but his bet against the subprime mortgages that made him his fortune, they regarded as mission creep. He was supposed to be a value investor in the stock market, and there was a lot of suspicion on the part of his investors.
And all of a sudden he became a short guy.
Well, yes, he all became a short bond guy, and he couldn't persuade people that this was a smart play. And so they started to take their money back. In response, he side-pocketed the trade. Now, you're only supposed to side-pocket a trade.
What does that mean? That's a massive jargon alert. Yeah, Michael Lewis, jargon alert.
All right, so it means you, my investor, can't have your money back because this is an illiquid instrument. Sure. And I can just hold the trade and your money in a side pocket until I deem it tradable.
And it paid off.
It paid off enormously. It made him a fortune. But people were furious he wouldn't give them their money back because they thought he could have sold these things at a loss, but sold them.
In your reporting for the book, did the illness help or hinder him? I mean, I can't get concentrated so often, particularly in the modern digital media.
He would say, and I would agree, that without the Asperger syndrome, he never would have had the patience to get himself into the position of seeing what was happening. He said, he said, only someone with Asperger syndrome would read a subprime mortgage bond prospectus. The degree of focus on the data it required was abnormal. But it really hurt him in the social dimension of managing money. And there was a huge social dimension to it.
Rip up the script. You're getting hired at Salomon Brothers is like legendary. You wrangled your way into some meeting out of LSE
You know, what happened was,
you literally can I say that on air? Can I say? I can't say that, Jim. Sorry. But how did you get that job?
How does he know what you're going to say? So if you can't say it. All right, so anyway, I ended up at a dinner that was for the Queen Mother in England, through a friend, through a relative, and I was seated beside the wives of the two people who ran Salomon Brothers' London office. And one of the wives at the end of the dinner said, "You really have to come work for my husband." And I kind of thought, well, why not?
That's how I got hired at Bloomberg.
No one else is offering me a job. Why not? And that's basically how I got my job. I had to go through some pro forma interviews, but I feel I was hired at that dinner.
So art guy becomes financial guy. What was the biggest shock of going into this before all your notoriety with books? What was the biggest shock of going into the financial world decades before The Big Short?
Well, this was the beginning of the boom in this phenomenon of paying young people lots of money right as they roll in the door. And so the biggest shock was that anybody would pay me lots of money to give financial advice. It was insane. So I thought it was a sign that the end was near. So that was the biggest shock. But the world, the financial culture we're living with now was created back then. And so you were watching the birth of a new culture, a bit like you're watching the birth of a new culture in sports now with this intellectualization of sports. Right. It's sort of like there's a big cultural shift that occurred in the early mid '80s on Wall Street, and we're living in that world still.
Here's a big shift. It's The Big Short. This chart here, this is just the Keefe Bruyette Bank Index. Michael Lewis, up we go, down we go. Yeah, we sort of rebounded. Do you have an opinion on the bank stocks? Are you doling out investment opinions here in 2011?
Once they didn't pay me for it anymore, I stopped doing it. I think what bothers me, the banks are essentially socialized institutions now. They live by a different set of rules than most of the people in the economy. They have been subsidized up the wazoo for the last 2 years. Right. They were failed institutions. Most of them would not be in existence if the government hadn't jumped in. So when you're asking me what happens to bank stocks, you're asking me what happens to public policy, it seems to me. So if you tell me what the government's going to do in relation to the banks, I will tell you what I think the banks are going to do. But they're at the mercy of public opinion. I mean, right. if the world turns somehow and all of a sudden, say, the Republican Party decides that we don't want to be subsidizing these institutions, we don't want institutions that are too big to fail, who knows? Well, maybe they'll get broken up.
In your travels, do we need big banks? I mean, Simon Johnson talks about breaking them up. Henry Kaufman talks about going back to the lovely art of a partnership structure. Jamie Dimon pushes against that and says we need to be big. Big isn't bad. Big wasn't bad for Canada.
What else is Jamie Dimon going to say?
Well, that's talking his book. That's fair.
He's talking his book. And you can't blame him for talking his book. The amazing thing is that he's allowed to talk his book after what happened in 2008. That the financial people are allowed to have the influence they've had in public policy. I think Henry Kaufman's got a very good point. That the risk, especially the kind of the risk taking, the partnership structure is the place for it, because then it's your money. The eyes that are on the risk are a different set of eyes.
I read this, and we'll do it on the way out. Here's Moneyball. What a wonderful book. I picked it up, and I literally read it cover to cover. I just like took 12 hours out of my life or whatever it was, and ran right through it. If you wrote Moneyball today, how would it be different?
Well, the edge now. I mean, I was writing about the edge of
quantitative edge,
right, of sports, and the whole idea that there was a quantitative edge was new. The idea that you could use statistical analysis to find inefficiencies in the way players were valued and strategies were evaluated. I mean, that existed outside the sport in the fringe, but actually being employed by a franchise that was new. And so that's not new anymore. It's overrun pro sports. I think, to me, if you set me out into the world and said I had to write about this movement in sports, the interesting place isn't baseball anymore. Baseball is the easy place to do this because the statistics are so good. Right. The data is so good. And the sample sizes are big enough, and so on and so forth. The interesting places are in sports like soccer or basketball, where it's very hard to distill what an individual's contribution. Very hard to assign statistically credit and blame to what happens on the court. Say, guy scores a basket, but 4 other guys were involved somewhere.
Is that like the financial crisis you just mentioned? The banks not held accountable. We have Dodd-Frank, which I'm not getting high marks on from different interviews. How do we hold accountable the financial types?
Well, the only way you do it is if their institutions can fail. I mean, they're still too big to fail. So there's no as long as that's true, there will be no accountability.
Well, let's look at this chart here. This is an elegant chart. Ireland and Iceland. You'll see it down here, Michael. Okay, it's pretty close. They're correlated. And then Iceland does better than Ireland in the downturn. I love your comment. It's 300,000 people run like a hedge fund. And we all know the story of Iceland and the differential to what can Ireland learn from Iceland?
Don't
be Ireland.
Yeah, well, no, don't shoulder the burdens of your banks. Let your banks go. Let the creditors take hits. They lent money to the banks.
When does this change? I mean, in Europe right now, we can't get haircuts from the private banks. In Europe, we're trying to put it all on the governments. They're going to the institutions, ECB, BIS, all the rest of them, Brussels. When does the pain click in?
Well, it is that you just put your finger on it. It's when the pain clicks in that you get a different sort of response. The big question in Europe is how willing are the German people to fund the losses of others, to subsidize behavior they disapprove of, and it's pretty clear they're not deep down that interested in shouldering these losses. So they're being kind of, they're cozied into doing it. But I think you just watch German politics very closely. What's going to happen is that the minority party in the ruling coalition is going to start raising hell about the cost to the German taxpayer. Right. And then it's all going to break up.
Here's the cost to the Irish taxpayer. The Irish people, Lewis, Irish eyes crying again, the Vanity Fair piece. Irish real GDP, I mean, it's gone nowhere. It's not like the U.S. Granted, it's a small nation. There's some other sidecar issues here. That photo that you have in your article of the houses, this is not Houston or Phoenix, is it? Those empty, vacant houses there have a unique Irish character, don't they?
Oh yeah, no, and it's you roll through the countryside, and they're called ghost estates. They're whole housing estates that are just completely empty, and that were actually never really built to be occupied. There were never the people to live in them. The housing, the madness, it makes what happened in the American real estate markets look sane. And it was just that much more extreme.
30 seconds. I love jargon. What's an IC investment? This from The Big Short, Michael Burry, ICK. What's an IC investment?
I think, doesn't he explain it in his email? It's an investment that when you look at it, it makes you go ick, or you worry that when other people look at it. Yeah.
Subprime was an IC investment.
Yes, it was an IC investment.
What's the IC investment right now?
I have no idea. I have no idea. What is? Well, you know what? The unpleasant investment, the one that causes people to turn up their nose at what you're doing, it's betting on the collapse of these countries. It's the sovereign default bet.
This is from Michael Lewis. Thank you so much.